particular type of customer or this type of category or this type of geography, there is very high risk sitting over there. And these will be taken care of by all these things.
Sure, sir. And so just one last data keeping question, sir. How many cards have they decreased the credit lines out of the cards in force that we have? Total number of cards that we have already decreased the credit lines.
We can't give you any specific details on this case, but let me assure you that wherever required, necessary credit actions have been taken by us. We can't give you specific details.
There's two things I want to add, and you have to remember that it's a question of hardship tools that any organization is going to exercise. At any given point of time, it is not that this is the first time that this is happening. You would always have, based on the performance of an account, you would have your hardship tools being invoked. Whether it is actually stopping to give him offer, whether you want to actually make more calls, certain type of transactions being declined. Now, these are some of the measures that you would start with. Reducing the limit is the last option that you would have, or cancelling the card is the last option that you would have. So what you would do is that you would put, and that is where we do that micro segmentation that we do. And these micro segmentation will actually decide that where he is sitting and what kind of hardship tools or hardship measures I will take. These hardship measures are very, very important. So it is a continuous exercise. And I would say that every organization, there was a news item that some banks have done it, all that, but I would say that it is something that every credit card company would always do to protect itself.
I understand that, but if you cannot give me the quantum, just give a yes or a no if you've done it or not.
So it has already been done by the organization. It is recurring, it's a regularly that we do it every week or every day also we might do it. That is where we have also put in some bots that we do. We have put our bots in terms of the transaction monitoring. I did mention to you when we were talking about the digital push that we were looking at. This is where these things trigger, and this is where every day, every POS machine, every transaction that is taking place is being monitored every day. And every time I'm going to actually profile him. This is the way we have monitored it.
Sure, sir. Thank you so much, and best of luck.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Equity Advisors. Please go ahead.
Sir, can you tell us in terms of, you mentioned that you have drawn 3 scenarios, and what are the various assumptions and what impact it can have on the provisions and credit cost under each of the scenarios? That is number one. Number two, what I wanted to understand that if I look at your ALM, 0 to 30 days. So basically, when I look at that size and suppose that entire goes to the moratorium, so does it mean, then you have to create, and suppose there is some slippage out of that, then how basically, the things will work out in terms of the provisions? So, if you can give some color on that.
The scenarios have been built based on the assumption and the information that keeps on coming from various sources. One was on the lockdown, when the lockdowns will be lifted, how many actually cases are there, what is the severity of the COVID, how many districts are opening up. So we have actually come out with 3 models. The base model is there. If we were assuming that if 17th the lockdown will go away, then when we can start business as usual. It's all based on algorithms that we have actually built and we have written. Point of time, then every department is following that. Whether it will be if the business, one is I can resume the business, but we are talking about business as usual. When the business as usual will start is what we are building in. So these are important things from our perspective of ensuring whether how quickly we can resume and how we quickly. This is equally important from the cost point of view, that how many people would I need, especially the NFT, how quickly can I deploy the people. All these things are built into this to come out with everything On the ALM, I think Nalin will reply to you, but I can tell you one thing, that the ALM is based on the policies and all the mismatches that are there, that is within the boundary that is to be kept. You can have a monthly, but you at the quarter end you need to have it should be fully matched. All these things that are laid down by the regulators, those are always adhered, and we have never ever breached them. But I think if Nalin, if there is a specific question, you can reply.
Yeah. Can you go ahead with the question, please?
Yeah, my question is actually different. My question was, based on the various scenarios, what you have worked out, what do you think is the estimated provisions and estimated credit cost under scenario 1, 2, and 3? That is my first question.
No, so now that will be a forward-looking statement. We are not giving such information. Internally, the company has worked out various scenarios, and we have prepared our business plan accordingly. Depending on what kind of scenario we face, we will act accordingly. Can't give you any specific number in terms of what is the reserve in situation A, situation B, or situation C. No, there.
Okay, I think we have replied to that.
Thank you.
Yes, sir.
The next question is from the line of Shweta Daktardar from Prabhudas Lilladher. Please go ahead.
Yeah, thank you, sir, for the opportunity. So I have a couple of questions. So when you mentioned that 8 lakh customer base has opted for moratorium, so was there any kind of filtration or any past payment history or any eligibility criteria, say credit bureau score, taken into consideration, or was it that every proposal that came forth was considered?
There are two things. It is not opt-out, it is opt-in. There are two options. One is that if you read the circular instruction or BI circular, it was very clear that it has to be offered to everybody. So how do you offer it? One option on the side that you could opt in and say, I want to exercise this opt-in moratorium. The second one was we also gave it within the policy, which is compliant to the Reserve Bank of India, and it clearly says that if you do not pay me in March, April, May, you will automatically be enrolled for the moratorium program. So the 8 lakh constitutes these two numbers. So I would not, how much would you like to do, what you want to do it, and out of that, almost 2 lakhs have also repaid it. They felt it necessary that there is no point continuing with it. So this is opt-in plus people who have not repaid it on automatically when the cycle comes and the due date comes.
Okay, so but lot has changed in this month of April. So what is the morat number in value terms as on today in the month of April?
As on today, ma'am, we will not be able to give you. On 31st, yes, there are numbers, and I have given you those numbers of 8 lakhs.
So one more thing, just taking cue from the previous question. So I understand you're not making forward-looking statements, but what was the thesis or the scenario analysis and the thought process assumed for this 490 crores kind of FC provisioning?
So I think let Aparna respond. Aparna, can you respond to this 489 crores? The CRO will say, because it was based on the ECL and whatever, the stages in IND-AS and all that, she should be in a position to actually respond to it.
Okay. Good evening. Am I audible?
Yes, you are.
Okay. So essentially what we have done is, just like Nalin had mentioned earlier, we have created scenarios and we have estimated what the impact of either. So there are essentially 3 variables to these scenarios. It is the extent of lockdown, what is going to be the social distancing norm that will exist, for how long it will exist, what will be the period by which the economic recovery will come back. So these are the variables that have gone into it. Basis this, we have estimated what our potential losses could be in 2, 3, 4, actually we've mentioned 3, but we have done a lot more of analysis and we've come up with what our peak losses could be as per an internal scenario. And we have provided in this overlay for our peak losses that could happen. And like sir had mentioned earlier, the whole idea of making this provision is I should be able to handle any losses that will come over the next 12 months, largely on account of the COVID impact. That is the basic principle behind this 490. Does that answer your question?
Yeah, partially. So would you like to quantify as such to attribute numbers to any of these variables?
So see, that's again an internal information about how we have come up with. See, what will the lockdown be? That's public information, right? So we have used all public information and we have made some amount of estimates internally. I won't be able to share with you exactly what is the scenario because that is more privy to internal. But we've come up with a scenario that we think is representative of what will happen to our business over the next 6 to 12 months.
Okay. So secondly, coming back to you, talking about receivables. So if I look at spend per average card, that has been declining quarter on quarter. The Q4 number has been down. So we had seen only loss of 10 business days as far as Q4 quarter is concerned. But going forward, even you have admitted the fact that the economic activity and the business per se is going to be pretty stagnant. So how do you see, and just another variable which you mentioned, that there will be a lot of small value transactions that will be going up, but discretionary led high value transactions are definitely going to come down. So these both points put together, how do you see the receivables and spend panning out in next first half of this year?
Hi, this is Girish. I'll answer your question in two parts. The first question that you asked around the spends part of it, if you go through the presentation on slide 9, it was very clear that the FY19 spends per card was around close to 1,42,000 and FY20 is 1,39,000. The difference is only 3,000 rupees, and this is after we have added a very large number of accounts, new accounts into the portfolio. Okay. So if you look at the number of new customers which has been added and digested and those customers' maturity grids or graphs, and still the spend per SIF is at 3,000 rupees less, and if let's say COVID was 15 days later, we would have seen maybe a marginal growth in these numbers. In fact, on the retail spend per card, we were seeing a growth till February end, and it is in the month of March that we saw a bit of decline because of this reason. However, and this is after the large number of new cards which has come into the denominator for this year. Okay. The second part that you asked on the receivables, is made up of three components. There is a component which is a term balance, which is EMI based balance, where some people have taken moratorium, as you are aware, and those balances will be payable from the month of June onwards if the moratorium does not get extended. That balances continue to go up. There is the second part of this overall receivables is the revolver balances. These are the balances where people who pay at least the minimum amount due, which is the 5%, and then continue but have not paid in full, and they revolve for let's say whatever period that they are comfortable with. So those balances are also constant. The third part of the balance, which is the transactor balance. It is there where we have had an impact from in the month of March also. The reason being that people were unable to spend, people who were transactors were unable to spend in the month of March, at least in the last 8 to 10 days. The online had stopped to take orders. There was some spurt in the essential commodities, which was non-discretionary item, but travel, railways, everything, those things, as our MD sir mentioned, had come to quite a halt. So given that these two are this is how the movement of receivables is. The total sum will be a mix of these three movements.
Okay. So, but I apologize, I'm harping on the same thing again. So again, because of lack of any discretionary spend going forward, at least for next 2 months, and very minuscule incremental expansion in number of cards, also corporate spends coming down. So how do you see this spend per average card moving going forward? Because that will also have direct bearing further on your receivables. So in the first place, how do you see the spends number would look like?
So as was said by Nalin, we will not be able to give you any forward-looking scenario. However, I can give you some indicators. SBI Card caters to mass and mass affluent customers. A large, even as a mix of our this customer profile, a large part of their present spend is also non-discretionary. The categories like departmental stores, grocery, utility bill payment, fuel, insurance, all those categories are continuing. There are, however, some movements because, for example, things like utility bill, all the departmental store and grocery thing, have now majoritarily become online rather than an online pause. We still have lockdown in continuation. After 17th, as was being mentioned, it will take some time for some of these things to stabilize to be able to come to the rightful conclusion.
Mm-hmm. So, but in the same period, there have been a lot of competition flaring up, especially now. Be it Amazon Pay or many others, who have been vying to pick up this particular pie. So how do you think, because everybody is looking for such grocery or online and utility kind of payments pie. So what's your thought process there?
At this point of time, we are in touch with almost all merchants. At this point of time, the issues are larger. The issue is that for these guys to be able to deliver, to keep their employees safe. So most of the companies at this point of time are trying to, yes, competition is important, but at this point of time, delivery to the customers is more critical. There are some offers that we are also running. Other people will also run offers, and those offers will continue to do. Until this point of time, as you have seen in the data, we have been gaining market share in year over year. And the way that we are positioned on online as well as our relationships and the focus, we believe that will continue to happen.
So merchants and network partners are very much there. They would continue the tie-ups as well as the MDR, and those things will stay, right? So that's a positivity that is coming already, right, from their side?
Yes.
Okay. So just last question. You just mentioned, we focus on mass affluent customer base. So do you have, say, any cap on the credit bureau score below which, you would not like to dilute? Something on those lines, would you like to quantify that?
My credit bureau score is at any given point of time. When we do a stress scoring, we actually factor that is one of the component that comes in. And I mentioned to you, we use another product which is called a credit vision, which gives the trending information about you. So, and then you have the application score that comes in, where you are working, what you do, what's your average salary, lot of stuff that goes into that. So thirdly, it is a dedupe score that you look at our own portfolio, and then you arrive at it. So obviously one would be careful not to do it, but it's not always that you will not do anybody. Sometimes a customer can move towards a secured category and he says, I need a card. So it is always, risk scoring is a combination of a lot of elements, and the risk model is extremely proprietary for any organization.
Okay, sir. Okay, that's all from my side. Thank you.
Thank you very much. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue.
So one of the reasons that we like to mention it in over here, 7 o'clock to 7 p.m. is the curfew, and many of us have to return also. So that's why we have kept it up to 6 o'clock. People will take almost an hour to reach back, or in case there are some drivers who have to again go back. So we'd like to actually keep it up to 6 o'clock.
Absolutely, yes, sir. We move to the next question. The next question is from the line of Parag from White Oak Capital. Please go ahead.
Sir, thank you. My question is, you said around 8.4 lakh customers have opted for moratorium. If possible, if you can quantify the amount, that's first. Secondly, among the people who have taken moratorium, is it possible to give some sector kind of a color that how much of them are salaried, self-employed, or within which sectors? Like probably if you can highlight on the sector part, that would be helpful. Thank you.
Okay, I think Aparna will take you through. There are some. Aparna, you can take through in on this.
Sure, sir. Can you hear me, Parag?
Yes.
Yeah, you are loud and clear. Go ahead.
Okay, so in terms of moratorium, I think like we mentioned, we did look at the data by salaried, self-employed, category of company. There's a fairly equal distribution. So it is not like only the worser customers went out and took the moratorium. In fact, I think like Mr. Prasad had mentioned in his presentation earlier, we actually also looked at it from a credit perspective, and a large majority of customers who had taken moratorium actually had a very good clean credit history in the preceding 24 months. So in terms of numbers, there are no real trends about whether any particular geography has taken a higher take-up rate of the moratorium or any particular segment. It's been fairly equitable across all, whether it was geography, whether it was the kind of customer. In fact, like I mentioned, the quality of customers who've taken the moratorium actually is better compared to the overall portfolio. If I was to rank them by distribution, the moratorium customer distribution is actually better.
Okay. And in terms of amount, ma'am?
So we put the amount as about close to 3,800 crores is the balance of that 8.2 lakh customers. As of
sorry, I missed the amount.
As of March, we had mentioned that it was about 8.2 lakhs of customers who have taken moratorium. The balance of those customers is about 3,800 odd crores.
Okay. Okay. Thank you very much, ma'am.
Thank you. The next question is from the line of Kaushal Kedia from Avenue Partners. Please go ahead.
Yeah, hi. Can you give some breakup on the customer profile as to how much percent is salaried and self-employed? In the DRHP, you had mentioned 87%. Is it still the same, or has there been some change in that?
I think the mix remains almost the same. 3 months would not change a portfolio with a large of 10 million customers. That we are at about 85% salaried.
Okay. And can you please give some light on what exactly a corporate spends? 25% of your spends come from corporates. What exactly is that? And you mentioned that you want to discourage them from spending on inventory. So were they spending on inventory with credit cards?
We are actually obviously we would respond to the risks that are sitting over there. So we are converting some of them into T&E. In fact, actually, I think all of them have been converted into T&E. So we are very mindful of this fact. We have gone back, and all our customers have been very, very, they have understood that there is a risk sitting over there, and then they would like that they are fine with ensuring that it is not done through the credit card, and they would use the bank lines and other things. As such, the demand is also not there much. So they are not, the manufacturing activity has come to a grinding halt and all that stuff. So presently, we have converted all of them into T&E.
Thank you.
So T&E is travel and entertainment.
Which is basically given to the employees who can use it for whatever purposes other than for personal use purposes. Manish, would you like to throw some light on the corporate card?
Yeah, sir, I can do that. Okay, because I think there were two questions on corporate cards, and I hope I'm clear. See, typically what happens is in T&E cards, the cards are carrying smaller limits individually, but a larger number of cards go to a corporate. While yes, at this point of time, the travel and entertainment usage will be less, but as it comes back, that usage picks up. Now, wherever we hold a security, a solid security from a corporate, like a fixed deposit or a bank guarantee, and it's a secured exposure, we give a little bit more flexibility to the corporate to use the card so that, the market opportunity can be also tapped to some extent in the business. But when it comes to unsecured exposure, in the present times and the way the things happen in this coming period, we have de-risked the portfolio by, restricting the usage to T&E, which is by the individual employees. So you always balance out the spend versus the risk that you take in a corporate card portfolio. While we have grown these spends, and even in this environment, we'll find out opportunities to grow these spends, but at the same time, we want to keep the risk very low in our corporate card portfolio. So I hope that answers the question and, throw some light on it.
Thank you. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. The next question is from the line of Ashish Sharma from Inam Asset Management. Please go ahead.
Yeah. Thanks for the opportunity, sir, and congratulations on a good set of numbers in a tough macro environment. Just on the spends part, sir, could you give a split of spends between retail and corporate? Or should we assume the ratio, the mix remains same vis-a-vis FY20? That would be my first question. And second would be in terms of if you have to split the spends in terms of contribution in the first half and in the second half, usually what is the split like? That would be the 2 questions.
So the spends on the retail and corporate mix has changed. It has got more in the favor of retail than corporate, because this year the corporate, as sir was mentioning his opening address, retail has grown by close to 39%, while the overall we have grown at the rate of around 27%. So the retail portion of the overall spend has increased. On the mix that you are asking on the first half to the second half, so on a normal year basis, if it is not this year is we don't know, because the pandemic is there in the first half of it, but otherwise on a normal year basis, typically the spends are 45-55 or in that ratio.
Thank you. The next question is from the line of Swechha Jain from ANS Wealth. Please go ahead.
Hi, sir. First of all, I would like to congratulate the whole team of, having such a spectacular performance in spite of the COVID-19. And, sir, I have few related questions, with respect to the impact of COVID-19, which, we are facing at an overall level. So first question is the 417 crore impact that we have mentioned. So I wanted to understand that impact. Can be assumed that this is just the last 10 days impact that we have faced in our profits?
No, it's not. We haven't taken the impact to last 10 days. This is the reserve that we have created for future impairments that may come in the next 6 to 12 months. That's what the CRO had mentioned earlier.
Okay. Thanks, sir. So, and a related question to this, to the credit cost, we've seen an increase in the credit cost. So do we expect the credit cost also to, be at such high levels for next couple of quarters?
So if you look at it, the credit cost right now has gone up because of the provision charge that we have taken extra. That is what has impacted the credit cost. Depending on how the situation pans out in the future, if our reserves are adequate, then I would say that the credit cost will not be at this level. It will come out because right now it's impacted due to the high reserve that we have booked in the March numbers.
Thank you. The next question is from the line of Jitesh Saraf from SBI Securities. Please go ahead. Jitesh Saraf from SBI Securities, please go ahead with the question. There seems to be no response from the line of Jitesh Saraf. We'll move to the next question. Next question is from Nishant Shah from Macquarie. Please go ahead.
Yeah. Hi, sir. Couple of questions. Could you talk about just backward looking? What is the kind of card customer mix that you have? Like, say, how many of within the salary segment? What would be the employee categories? Like, say a Cat A or a Cat B employee versus say an SME or a startup kind of employee. that kind of mix, if you can give? And like similarly within the self-employed segment, how many, like what proportion, would it be more than 50% within the self-employed that are that are self-employed professionals? That's the first question. If you could give some, some bit of backward-looking color on the customer mix.
Aparna, could you just respond?
Yes, sir. So we've not put those numbers out there, so I'm just going to give you, Nishant, some approximate numbers. Like we've been mentioning, our salaried portfolio is about 85% of our portfolio comes from salaried, and within that, more than I would say 60-65% of that is actually a Cat A and a Cat B kind of companies. And when I say Cat B essentially refers to government. So a significant majority, almost 60% out of that 85 would actually be coming from the Cat A and Cat B. And the balance are, of course, the Cat C and some other retired and pensioners, which is a very small proportion. That's where it comes from. Now, in terms of self-employed, see, this is information that's collected on the application form. So to that extent, it's not really verifiable in that sense. But even there, we are about 60%, which would be stating themselves as professional, and the balance 40% would be businessmen. Now, what exact business is not something that's accurately available, so I wouldn't want to put that out there, but that's the overall landscape.
Sure. And just one clarity here, when you say 60% of salaried, you mean 60% of 85 or 60% of...
So let me put it as a total. Okay, out of 100, 15 are self-employed. Okay, about 24 would be Cat A. Okay, and about 31, 32 would be Cat B, and the balance is Cat C.
Okay, perfect. Yeah, that's very good. A second question is more on this moratorium side. Among these customers, could you clarify, whether largely this is the moratorium availed is on revolver loans or largely on EMI loans? How exactly is the split over here?
Okay. Nalin, do you want to take that or do you want me to answer that?
Go ahead, Aparna.
So, Nishant, there's no, on a card use, there's really no difference. So, it's not like there's an EMI loan and a card loan, okay? At a customer level. So, customer is supposed to, if I am a customer who has a retail spend as well as an EMI, then every single month, the due that I am charged and billed for is essentially 5% of my retail balance and the EMI that's payable in that month. So if you take moratorium, you take moratorium for both. So it's not EMI special different from transactor or the revolver balance. Does that answer your question?
Not entirely. So basically, I was just wondering, we would know what the split is for this entire 3,800 crores. What proportion pertains more towards EMI and what proportion pertains more towards a transactor or a revolver, correct? So could you probably split that out?
So I don't think we've put that split out there. So we are right now, the 3,800, like I said, is across those customers. And I think the split is not different. Whatever was there earlier in terms of our asset split, that split is still not very different. So I don't think we should break up this 3,800 between EMI and retail and all that, because it doesn't really make a difference to how you're going to look at that customer. Like I said, the customer is on moratorium and he's taken the moratorium for his entire balance.
Thank you. Due to time constraints, we'll be able to take one last question. We take the last question from the line of Dhaval Gada from DSP Investment Managers. Please go ahead.
Yeah, thanks, and thank you for the detailed disclosures and presentation. So I had two questions. First one was for Nalin. What was the acquisition cost per card in FY20? And the second was for Aparna. You mentioned that you've taken peak delinquency to determine the provision number. And earlier in the call, you mentioned, I think someone mentioned that 35% is the recovery rate. So would that, if I gross up that, is that the peak delinquency that came out in your stress scenario? Just trying to confirm these two. And one more thing was on the collection capacity. What's the kind of increase that we've done now versus pre-COVID? Some quantitative numbers around collection capacity. Yeah, thanks.
Manish, you can go ahead with the cost of acquisition question.
Yeah. I think previously also when the RHP was there, we had given a sort of an indicative number that they stay in the market range. But to give you a very rough approximate range from a past data standpoint, depending upon quarter to quarter movement of business, because typically last quarter normally we do well. Had COVID not been there, we would have added some more cards. In that case, somewhere approx 3,000 to 3,500 cost of acquisition in terms of the sales cost or the channel costs, is approximately in that number. So I can give an indication of where it generally stands, which comprises our manpower cost, our incentive for people, the rentals that we pay for various things. It also includes the variable payouts, some of the payouts that we carry out. So it ballpark benchmark number stays in that particular reference range, fairly consistent across the full quarters of this year, moving around that particular range. Yeah.
So for the year, it was still in the 3,000 to 3,500 range.
So I'm saying approximately in that range. I can give you a range. It keeps on varying, depending on circumstances of a particular month. So I can give you an approximate range for the number.
Sure. Okay. On the other question?
Aparna, you can answer the other one.
Okay. So I'm just going to take, at the risk of a little bit of a repetition, I'm just going back to what the logic for arriving at the reserves are. And the answer to your recovery question is actually different. Okay. So the question earlier was, what is the kind of recoveries we make out of accounts that get written off? And to that, Nalin had replied that 30% of what we write off normally comes back in 3 years. Okay. So that's a separate piece of information. What is the logic that we use to arrive at the COVID overlay provision that you're seeing here is, like I mentioned earlier, we did scenarios using a number of macroeconomic variables and variables specifically related to COVID. So things like, how long will the lockdown be? How long will the social distancing be? What is going to be the kind of recovery period? When will economic recovery or activity be back to where it was prior to the COVID? And then we estimated the impact of each of these on our activities, on whether my collection capability, on how the spend will move, how the balance will move. So we estimated the impact of each of these individual variables, and then we looked at what would be my peak losses over the next 12 months. Okay. Now, obviously, this is to some extent an estimate. The principle behind the overlay provision was I want to reserve today as a business to save myself for any future losses that would arrive out of the book that I have today. Okay. So it is just an estimate of future losses basis these macroeconomic variables. Now, does this take into account some amount of recovery? Obviously, it does, because if I'm going to estimate losses in the same period, I've actually estimated how much of those losses will I be able to recover within the same 12-month period or not. I have not considered either losses or recoveries beyond the next 12 months. Does that answer the question?
Yeah, and just one follow-up to that. What's the most critical variable in your sensitivity model?
So, I mean, it's not like there is, the model wouldn't really be a robust model if I had any one variable which was having a higher weightage. So the weightage is across, I mean, we looked at almost 8 to 10 variables, and it's not like any one variable was the most significant one.
Understood. And just the last one on collection capacity, where we are today versus pre-COVID. Thanks.
I think would you like to take this question?
Oh, yes.
Or no would like to? You can take this question?
Yeah. Okay, I can do that.
The Chief Operating Officer is going to take that question, Mr. Richpal. I just want to tell you one thing that just want to tell you one thing, that this provision that look at it, and there are various things that all of you have been talking about it. I think it's very discretionary and it's a prudent, proactive measure that the company has taken. Please look at it from that perspective, that whether the company was strong enough, it is capable enough to come out with these provisions and to see to it that the profit also remains very, very strong. And these provisions, don't consider it as actually all that risk sitting in the organization. It's not a risk that everything is sitting in the organization. It's a prudent step that we have taken. It's a proactive measure that we have taken to see to it that the provisions are there in case something happens. Nobody knows that how severe the COVID impact is going to be. So we could have just gone ahead and said that, okay, this is what is the provision. The regulator is saying please only provide 10% of the provision for these accounts where a moratorium and other things have been given. We could have very easily gone ahead and done that and come out with a small provision, and we could have shown a good result. But the point is, I think it is to be understood that the company felt that it is important, prudent, and a good management practice to provide for these provisions and to ensure that in case there could be a risk that may come up at some stage, you have taken care of it. What it will also do is, in this future year, next year, you would have assuming that it is fully utilized, at least this year's loss will not be actually consumed by the profit that is going to come up. I think this is what very, very, very important from our perspective. We are on Ind AS. I mentioned to you at the beginning, we are on Ind AS. We are not on, as such we hold high provisions because of the accounting norms that we have, and that is what we would like to continue to actually be looked at. If you look at it from that prism, you would find that it is an absolutely forward-looking statement that this company has gone ahead and made this provision. Simultaneously, the profits are even better than December numbers that we have. I think, Rishpal, if you could
I'll just give you an overview of our collection capabilities. Look, our collection...
That would be great. Yeah, thanks.
Okay. I'll just give you an overview. Our collection basically workforce is, comprises of three, components. One is our, permanent employees, permanent resources. We have, basically about over 700 employees who are permanent, employees of SBI cards. Then we have telecalling centers. These are vendor resources, basically vendors who have been onboarded for telecalling. That is, calling customers for collection activity as well as for recoveries. We also have agencies. And these agencies, vendor agencies, are located across the length and breadth of this country. We have almost close to 300 agencies which are on our roll, and these telecallers as well as the field resources of agencies are in the range of around 6,000, 6,500, and they keep varying and they keep changing from month to month as and when we keep onboarding vendors as and when we require. Now, as it was shared with you during the presentation also, due to COVID, our field activity has come to a complete halt in the initial stages. So what we have done, we have enabled all our permanent staff, even while they were not telecallers, all across the bands and across the seniorities, all our staff, permanent staff, have been enabled for telecalling from home, as well as the telecalling centers, which also, again, because of the restrictions on movement, physical movement, these telecalling centers of vendors had also got shut. So we have used dialer solutions, cloud dialer solutions. We also have used our CRM platform that we call Collections24 for enabling the entire telecalling workforce of these vendors to call from home. Additionally, these agencies also have telecalling staff. So those telecalling staff as well as some of the field staff of the agencies have also been enabled to call from home. And because these are the times when, some of the activities are slow, we have also roped in cross-functional resources for, calling activities. So, and this is what we will continue to evaluate as and when we need more people. There is bandwidth available within the company, and then, that there's a flexibility of, onboarding more people. And as we speak, let me tell you, like Sir had mentioned earlier, we are, looking at activities zone-wise. In the green zones in this country, of the, 280 odd or close to 300 agencies, 80 agencies have already opened shop. So physical activity also partially has been restored.
Okay, I think that should bring us to an end of this investors call. I just want to reassure everyone sitting over there that the company has solid business model. It has a very strategic outlook in terms of what it does. It obviously, the provision that is there should not be mistaken as if there is a problem sitting in the organization. It's more of a proactive measure taken by the company to ensure that in case there are anything that could actually, you have taken care of it. We could have very easily, I think most of the banks or others, our competitors would have gone ahead and done those bare minimum that is required. We felt that it was important for us to actually come out in a more prudent way, especially when the ECL could have been pretty low. So I want to assure you that the digital push, the co-brand relationship that we have, the banker relationship that we have, the risk modeling that we do, the new generation modeling that we do, the machine learning and the bots that we have in the risk model, the risk department, the data that feeds the spends, all these put together are very, very strong in terms of what we are doing. And the risk department has come out working very hard to come out with a model which should actually take care of the prudence that we have done it. Please be assured that there is no such big risk sitting over there in the organization. So thank you very much. I'd like to thank everyone to be there. Thank you very much.
Thank you very much. On behalf of SBI Cards and Payment Services Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your line.